Hello, welcome to OneAZ Wealth webinar on leveraging Secure Act 2.0, how to grow your business. My name is Robert Nichols. I'm a wealth advisor located in the Northern Arizona region at OneAZ Wealth Management here at OneAZ Credit Union. Our full-time professional financial advisors assist clients and members of the OneAZ Credit Union all over the great state of Arizona. We're excited to bring these educational topics directly to you, and we are planning for more in 2024. Here is our information page. It contains all our legal disclosures for your convenience. Please always check our OneAZ Wealth website for upcoming webinar events. For better audio, the webinar will be in listen-only mode. We are fielding your questions at the end of the webinar. Please email any questions to oneazwealth@oneazcu.com. We will be compiling your questions and we'll answer them at the end of today's presentation. If we do not get to all of your questions, I promise we will respond to you directly. Last, for more information about OneAZ Wealth Management and our team of wealth advisors, visit oneazwealth.com or use your mobile device and scan the QR code on the screen now, and it will be at the end of the presentation as well. You can also connect with us on social media on Facebook, LinkedIn, and YouTube for more exciting resources and helpful information. So let's get started. Our guest speaker today is Neil Patel of Patel Advisory Group. Neil's interest in the mechanics of business started early and was influenced by his entrepreneurial family of operators and investors. After graduating from Chicago's esteemed Loyola University, Neil worked for public and private enterprises, affording him an invaluable insight and experience into the finance, operations, and management functions of businesses in multiple industries. Neil launched his practice in 1999, and for nearly 25 years, he has advised hundreds of diverse businesses, providing him with a uniquely wide scope of real-world hands-on experience. As a result, he understands firsthand the challenges and opportunities business leaders face today. His professional mission has been focused on helping clients navigate today's complex business environment, improve visibility, and grow. Neil is best known for his perspectives on financial leadership. In this capacity, Neil is able to help accounting and finance teams align with operational targets and strategic objectives. In doing so, Neil is able to help business leaders achieve their goals, reduce stress, and find professional and personal fulfillment. Outside of the office, Neil enjoys hiking, camping, traveling, spending time with friends and family, and spoiling his chocolate lab, Lily. Welcome, Neil. Thank you very much for joining us.
Thank you, Bob. It's a pleasure to be here.
Right, thanks. So today's topic is the Secure Act 2.0. The Secure Act, officially known as the Setting Every Community Up for Retirement Enhancement Act 2.0, and aims to enhance retirement savings opportunities and provide various benefits to small business owners. There are also some key benefits for individuals as well. In 2023, the Secure Act 2.0 reduced the IRS penalty for taking out less than a person's full required minimum distribution from a 50% penalty for the underpayment to 25%, and even 10% if that is corrected in a timely manner. Now, as with all of this, you should consult your investment professional or tax advisor about your specific situation. Under the Setting Every Community Up for Retirement Enhancement Act of 2019 and revised in 2022, the Secure Act 2.0, the required beginning date of RMDs, required minimum distributions from people's individual retirement accounts, is raised from age 72 to 73 for any person who attains that age 72 age after December 31st, 2022. There's still no change to RMDs for people who turned 72 prior to January of 2023. Now, that's for individuals. Let's focus on businesses, employers, and owners. So, Neil, why don't we talk about some of the tax credits that are involved in Secure Act 2.0?
So, okay, sure. So the Secure Act 2.0 is kind of the second iteration of the Secure Act, which was aimed to addressing the need for Americans to be able to save more and save more easily for their retirement. And this version of it, the 2.0, was to focus more on helping employers provide easier and affordable retirement plans for their employees. And in order to entice employers to do this more, they've increased the credits from what they used to be in the original version of the Secure Act and also added some new credits. But I think the highlight for this also should be not just so much the legislation or setting up the retirement plan, but what it does for your business and your workforce, because it's a great tool for attraction and retaining of qualified workforce and the financial health of your team itself. So the startup credit, which is basically it increased from 50% to 100%, but it helps offset the cost that you as an employer might incur for setting up and administering your plan, paying third-party administrators, setting up the plan, and then also educating your employees about the plan. Because a lot of times what I've noticed with my clients is that just setting up the plan is not enough. You need to also educate your team about what's available to them. The second big credit for employers is for the first 5 years, they're going to give you a credit for your contribution portion to the employee's retirement plan. Now, I do want to say that you want to work with a qualified, financial advisor to make sure to what degree and extent these credits apply to your facts and circumstances. It's not a one size fits all situation. And you really want to be thoughtful about, what actually applies to you under the plan that you want for your business. But we're talking high level and general benefits under the Secure Act.
Yeah, and I think these are, some really good tax benefits and credits, especially as more and more states around here are mandating that employers of certain size have these type of plans available for their employees. That goes into some of the reduction in costs and expenses. Let's next talk about how it can reduce some of the administrative burden, because that's also a push or a point that business owners often have difficulty contending with.
Sure, there's resistance on that, considering how many hats a small business owner wears and all the directions in which they're pulled. The thought of taking on something else that might be to be put on their plate in this regard isn't exactly, welcomed with open arms. So they wanted to reduce the administrative portion of the plans that are necessary for you as an employer to be in compliance, and to facilitate having a plan and offering this benefit. So they've attempted to do that under Secure Act 2.0 to make it a little less onerous for the business owner. Another way to make it a little less onerous is in the onboarding of new team members. They put in an auto enrollment requirement to basically say, hey, when you come on board and we have open enrollment in the plan, everybody is going to get auto enrolled into the plan. That doesn't mean everybody is required to defer, but it means that they are automatically enrolled. So when they want to participate, they can. And if the employer has contributions, they're going to match on a non-elective basis that those employees are already set up. The owner doesn't have to stop everything, contact people, set employees up, have paperwork filled out, so on and so forth. It's kind of done on the front end to increase the participation rate.
And like you say, a lot of our business owners, they're very, very good at the business that they run, but they don't want to have the knowledge of all of that. That's where we can bring in a lot of groups that can tie all of this in together. And the auto enrollment, even if the employee doesn't want to contribute out of their own paycheck, if they want to receive, or they will receive the employer's contributions, so they will need to go on, create a username and password on the website for the or the investment company, and also create a beneficiary and a deferred default investment choice. So it's important that that everybody, even if they're not going to contribute out of their check, also sign up. So the next is some of the higher contribution levels for older employees and some benefits for younger employees.
So one of the things that they tried to do in the Secure Act was to address an underlying problem that the retirement savings rate for Americans is very low. And so their idea behind this is that if more employers were able to offer this to their employees, that the participation and the savings rate would go up. This is the theory behind this kind of legislation. So it carves out specifically for those that are 60 to 63. It allows you to increase catch-up contributions, increase the amount of your contributions to put more away into your retirement under the Secure Act than what was available before. There were caps on how much you could put away, and there was, not the ability, even if you had the funds, to put more away. The second challenge that they noticed was the amount of student loan debt that younger team members are carrying, and that they have to choose between servicing their student loan debt and also being able to contribute to a 401k. Sometimes being able to do both is not a reality. So under the plan, under the Secure Act 2.0, they created a mechanism which still has to be worked out mechanically in terms of how to make this work with the plan. So it's, again, important to work with a qualified financial advisor to help you navigate this if this is a situation that applies in your company. But it's essentially saying that if a employee had $5,000 of student loan payments in a particular year, that those payments could be deemed as being contributed into their 401k to allow for matching from the employer. So they may not be able to defer much more out of their own paycheck, but they can actually use the student loan payments as a placeholder for their deemed contribution, so the employer can contribute on their behalf, and they could still start to develop retirement savings.
Right. And then there are also some incentives for employee retention. And one of them is allowing plans of various sizes for various different employers. Flexible plan options. The Act offers more flexibility in plan design, including pooled employer plans, or what are called PEPs, or what we also refer to as MIAPs, multi-employer aggregated plans. And that allows them to be able to reduce costs and administrative duties while also sharing them with other like employers or like businesses. And it creates economies of scale. And then, as you were talking about with those older employees, 50 and above, 60 to 63 and above, it also allows Roth matching contributions. So those would be after-tax contributions that would go in and allow them, after a period of time, to be withdrawn tax-free later, which could be a very good planning strategy for a lot of the older employees to stay with the business, stay with the plan that offers that. So the next is going to be improved access. And Neil, why don't you talk about some of the, I'm sorry, skipped one, the emergency savings accounts and income. Why don't you go over some of the benefits there?
Sure. So the government has come to the conclusion of discovered the reality of the situation that sometimes a lot of Americans are having to make a choice between, funding their retirement and setting up these other accounts. So they've tried to allow for this under the Secure Act to say, hey, I want to portion off a part of my retirement account as this emergency savings account. Now, there's limitations for what constitutes an emergency, how much can be withdrawn per year, and so on and so forth. But it allows for situations of an unanticipated medical bill, an unanticipated auto repair expense, unanticipated moving or temporary housing situations. It allows for use of the money that's in the retirement account to be used for this purpose without a penalty. Whereas in the past, money's taken out of your retirement account prior to a certain age and prior to certain events was subject to a penalty for early withdrawal. All right, so they wanted to address that issue and help encourage savings for Americans through a retirement plan through work by allowing this. Second was the solutions or products that were available in the retirement plan. Whereas in the past there were traditional retirements, products that were available to choose from. Now they've expanded that to allow for annuities and things like that. Now again, the choosing the right product for your facts and circumstances really, I would encourage you to meet with a qualified financial planner to find out if you've got the right product for your facts and circumstances and your specific situation. It's not a one-size-fits-all, so we want to make sure that you pick the right product for your needs in this situation. But the plan allows for that now.
Absolutely. It really kind of combines the old idea of one business would have a defined benefit plan or a pension. Another business would have a defined contribution plan or a 401k. This allows that lifetime income pension idea inside the 401k. And I think that really adds to, future retirements for people. Now, also, there is some improved retirement plan access. It provides to make retirement plans more accessible and easier to maintain, which can help small businesses comply with regulations without undue burden. And it also eases the IRS guidance and resources for plan sponsors and can help small businesses better navigate the complexities of retirement plan management. We have many providers that we use through OneAZ Wealth that work with all payroll companies and helps bundle not only the payroll that they may already be using without having to change, but also the TPA, the third-party administrator that does all the record keeping, as well as the investment company to streamline and simplify the processes so they don't have to go out and find each one of those. We can help streamline that all together and bundle it. So that can help as well. And then one of the other portions that the Act encourages is the integration of financial wellness programs with retirement plans, which can help employees better manage overall financial health and improve their ability to save for retirement, because it can have sources to help them with individual budgeting, to help with debt management, to help with insurance needs and long-term care for older employees or employers. Also available, most of this is available at no cost to the plan because it's available on the 401k provider's website. So there would be a library that people could go into with calculators and educational white sheets and be able to look up the different information that they would need. And it provides a more holistic employment retirement plan, and it doesn't cost the employer anything additional. So I think that's a good benefit, because a lot of employees now want more information, and this provides it to them. So Neil, I think that really covers the different aspects. Why don't we recap, the different takeaways that we have for this webinar?
So, okay, so this is on a very high level on just kind of the highlights of the Secure Act 2.0. It did increase the tax credits available for setting up and funding the plan. It allowed for a little easier administration. I wish I could say it was zero administration headaches, but that's not realistic. They've attempted to make it a little bit easier for employers to set up and administer the plan. They've offered different options for the retirement savings. They've encouraged retention incentives for those that are 60 to 63 to be able to put away more money. And then also for younger team members who are also juggling student loan debt to be able to also participate in the employer's retirement plan. It encourages long-term savings overall by having the plan with the training and the financial wellness that's available. The compliance and protection aspect of it, they've taken some of the bite out of inadvertent mistakes in compliance and administering a plan. There are things that will have to be done, to be in compliance with the plan. And that's why working with a good qualified financial planner who can help you build a team to handle all the respective components of what goes into making this work well is really key. They can help be the quarterback to kind of put all that together for you and reduce the weight on the business owner for having to carry it alone or in a compartmentalized way. And then the financial wellness program that they created under Secure Act 2.0, because the government finally realized that, by having a mandate to employers to offer, or a request for employers to offer retirement plans, isn't in and of itself enough to create financial wellness for the team members. They need time and ability to be able to be educated about financial concepts and saving for retirement and what it means and what it can mean for them. So having that coupled with the plan is really a powerful thing that 401k plans can help kind of automate.
Yeah, and for business owners, the tax credits to save them money, the simplified plan administration, the improved compliance, that, the IRS has never been the kinder, gentler portion of our government, but it alleviates some of that, sometimes overburdensome regulations. So there were a couple of questions that came through. How long until the Secure Act revisions come into law? Those are being eased in over a period of time, but they're also being changed. As Neil had said, work with your person, because the way it's interpreted this year may be a little bit different next year. And that's why we want to work with, a team to make sure everything is fully compliant and up to date. One of the other questions we got, Neil, and I think this one would be best for you. Why does a succession plan matter for employees, not just employers?
So there's a study, the state of employer employer or state of business readiness in the event of a secession, and it's at a very low rate because business owners, again, are very busy. They're working on their business. They're handling, juggling different things on a daily basis. They're not really thinking about the secession, and that really is a separate mindset that needs to have time devoted to it, to think about. If this is your largest asset in your family, and it is meant to produce a certain amount of retirement income for you upon your eventual exit from the business, then it's good to know a baseline figure of kind of what's the value, what is this business worth? Does it help me get to my goal? Secondly, and this is the case for a lot of my clients, it's a familial business. They've started these businesses from the ground up, and a lot of them have employees and team members that have been with them since the beginning. They've become sort of family members. So the question becomes, hey, if I sell the business to a third party or a private equity group, what happens to my people? How are they going to be, taken care of in the event of a sale? And that's a big question to ponder and ask, and you want to give yourself enough time to really kind of think about that, if that's something of importance to you on the exit.
Well, and I also think that the employees a lot of times can see when a business owner is coming to the end of their career or looking to start transitioning, and we don't want to have them leave before and then that not make the business as valuable to sell, or a business that someone wants to buy and then have a lot of employees leave because it was a shock. I think it's one of those where to have these kind of plans in place gives everybody a little bit of peace of mind.
Exactly. I think giving yourself enough time to plan that out is a big thing. And one of the big determinants of value in your business is going to be the quality and productivity of the workforce in place. That's what a prospective buyer is looking to purchase in your company, is a going concern with a qualified workforce in place. And the Secure Act in one way kind of helps bolster that team member and the financial health of that team member to allow you to cultivate that one component of it.
Absolutely. And we know we're dealing with business owners, and we promised you a half hour. Thank you very much for all of your time. If you have any questions, comments, please feel free, reach out. We want to thank everybody for attending and joining us. We hope that you found it valuable and look forward to hearing from you in the future. Neil, thank you very much for your time and your information and your expertise. I very much appreciate it. Thank you.
Great. Thanks, Bob.
Okay, everyone, have a good day. Thanks.
Take care.
Bye.